Investment Analysis of OMV AG, OMV, Evaluating the Transition to an Integrated Chemicals, Fuels, and Energy Model. I. Executive Summary, Investment Thesis and Key Findings. OMV Aktiengesellschaft, a globally integrated energy and chemicals company headquartered in Austria, is currently navigating the most significant strategic transformation in its history. The company is actively shedding its legacy reliance on volatile upstream exploration and production (E&P) in favor of a diversified, structurally de-risked portfolio centered on sustainable chemicals, fuels, and energy under its Strategy 2030. The primary investment thesis for OMV rests on the transformative impact of the Borouge Group International (BGI) transaction and the delivery of high-profile near-term growth projects such as Neptune Deep. The guaranteed annual floor dividend stream resulting from BGI is expected to provide substantial stability to the group's cash flow profile, counteracting the high cyclicality historically associated with the integrated energy sector. The current enterprise value/EBITDA multiple of 3.7x suggests that the market has not yet fully incorporated the long-term, stable value expected from this strategic shift. I. Corporate profile and strategic transformation. A. OMV AG, a vertically integrated major in transition. OMV operates an integrated model encompassing energy, E&P, gas, fuels and feedstock, refining and marketing, and chemicals and materials, anchored by Borealis. This structure has historically subjected the company to extreme volatility dictated by global commodity prices. This volatility was acutely observed between 2021 and 2024. OMV's EBIT surged to an exceptional $12.902 billion in 2022, marking a 115.4% increase from 2021, driven by extraordinary geopolitical market conditions. However, this peak was immediately followed by steep declines, a 56.15% reduction in 2023, $5.657 billion, and an 18.63% further decline in 2024, $4.603 billion. This dramatic fluctuation in core profitability necessitated the strategic pivot to mitigate future financial instability. B. Strategy 2030, the Integrated Sustainable Chemicals, Fuels, and Energy Model. Management has clearly articulated that the traditional business model cannot be rationally sustained, driving the pursuit of Strategy 2030. This strategy seeks to reposition OMV as an integrated, sustainable chemicals, fuels, and energy company committed to achieving net zero greenhouse gas emissions by 2050 at the latest. The emphasis is firmly placed on value creation through sustainability. Decarbonization roadmap and portfolio shift. The strategic plan includes specific decarbonization targets based on 2019 levels. Absolute Scope 1 and 2 emissions are targeted for a 30% reduction by 2030 and a 60% reduction by 2040. Absolute Scope 3 emissions are targeted for a 20% reduction by 2030 and a 50% reduction by 2040. The carbon intensity of the energy supply is aimed to be reduced by 15 to 20% by 2030. Operationally, the shift entails a significant decrease in the fossil fuel portfolio. By 2030, OMV intends to reduce its oil and gas production levels to approximately 350,000 barrels of oil equivalent per day, KBOED. Simultaneously, crude distillation throughput will be cut by 2.5 million metric tons. The focus areas for future growth include sustainable and bio-based fuels, renewable electricity for captive use, and developing geothermal energy. The joint venture Deep with Vienna Energy is a tangible example aiming to harness Vienna Basin geothermal potential to supply up to 200 megawatts of climate-neutral district heating. This application of OMV's established expertise in geophysics and drilling to adjacent sustainable energy fields increases the feasibility of successful project execution. Furthermore, neutralization measures are necessary, with OMV planning to develop around 3 million metric tons per year of carbon capture and storage capacity across all business units by 2030. Financial resilience and strategic pace adjustment. Amid a challenging environment, OMV announced an adjustment to its strategic capital expenditure plan. The company is reducing cumulative organic capex by €5 billion between 2026 and 2030. This measure aims to reinforce financial resilience, enhance efficiency, and strategically adjust the pace of sustainable investments. This pragmatic reallocation of capital ensures that the company prioritizes robust cash flow generation from its integrated portfolio while focusing investments on growth areas like Neptune Deep and the chemicals segment, signaling a financially disciplined approach to the energy transition rather than a rapid, potentially over-leveraged pursuit of green targets. 3. Deep dive into strategic growth segment, chemicals and materials. The future success of OMV is intrinsically linked to the performance and integration of its chemicals and materials segment, which offers a path to lower volatility and higher through-the-cycle margins compared to traditional E&P. A. The Borouge Group International (BGI). OMV and ADNOC signed a landmark agreement to strategically combine Boreas and Borouge into Borouge Group International, a new entity set to become the world's fourth-largest polyolefins company, valued at over $60 billion. This transaction is expected to close in Q1 2026, subject to customary regulatory approvals. Financial structure and guaranteed cash flow. The BGI entity will be an equal partnership, with OMV and ADNOC each holding a 46.94% shareholding. OMV will inject €1.6 billion in cash into BGI to equalize shareholdings, with this amount reduced by any dividends paid out prior to closing. The financial contribution of BGI is expected to be profound and stabilizing. The company is forecast to generate a through-the-cycle EBITDA exceeding $7 billion per annum. Crucially for OMV's valuation and credit profile, BGI will commit to a minimum total annual floor dividend of $2.2 billion. Of this, approximately $1 billion is secured as an annual floor dividend stream directly attributable to OMV. This guaranteed fixed income stream acts as a non-cyclical buffer, significantly stabilizing group operating cash flow and reinforcing the company's commitment to a high and resilient dividend policy. A key expansion project, Borouge 4, an ethylene and polyethylene facility, is currently being developed outside BGI but is envisioned to be recontributed to the new entity at the end of 2026 once fully operational. This expansion, estimated at a cost of $7.5 billion, is expected to provide an additional through-the-cycle EBITDA contribution of around $900 million per year. B. Market dynamics and regulatory headwinds for European chemicals. While the strategic rationale for BGI is diversification and stable cash flow, OMV's European chemicals operations face specific structural challenges. The European polyolefin sector continues to struggle for competitiveness against global peers due to complex economic currents and intense competition from imports. The impact of the Carbon Border Adjustment Mechanism, CBAM. The European Union's shift from output-based free emission allowances, OBA, to the Carbon Border Adjustment Mechanism, CBAM, introduces structural headwinds for OMV's domestic chemical and refining segments. While CBAM reduces carbon leakage more effectively than OBA, the regulatory change may reduce activity levels in the EU's emission-intensive and trade-exposed EITE sectors. For refined petroleum products and chemical products, segments vital to OMV, the positive output effects of CBAM are modest compared to the previous OBA system. Furthermore, downstream EU industries, including OMV's operations that rely on inputs from CBAM-covered sectors, will face increased input costs without comparable border protection on their finished products. This dynamic reduces competitiveness in both domestic and export markets. This structural headwind confirms that OMV's pivot toward cost-advantaged, geographically diversified assets via the BGI transaction is not merely a growth initiative, but a necessary adaptation to maintain long-term profitability in a complex regulatory environment. I. Operational performance and financial resilience. A. Segmental analysis. Q3 2025 Clean CCS focus. OMV's management utilizes the Clean Current Cost of Supply, Clean CCS, operating result to provide transparency by adjusting for inventory holding gains and losses. For Q3 2025, the group reported a strong financial performance, with the clean CCS operating result rising approximately 20% year-over-year to €1.262 billion. Fuels and Feedstock was the largest contributor to growth in Q3 2025. The clean CCS operating result surged by 102% to €413 million. This robust performance was driven primarily by strong refining margins, with the OMV refining indicator margin Europe more than doubling to $11 per barrel. This strong margin environment provided crucial, high-quality cash flow necessary to fund the group's strategic transition capital expenditure. Chemicals and Materials. This segment saw a significant 64% rise in its clean operating result to €222 million, supported by improved olefin margins and Borealis's asset reclassification. However, polyolefin indicator margins in Europe declined, highlighting short-term pricing pressure despite strong underlying operational gains. Energy Upstream. The energy segment's clean CCS operating result decreased to €622 million. This reduction was expected, stemming from negative market effects and a production decline of 8% to 304,000 barrels of oil equivalent per day, KBOED, mainly due to the divestment of Sapura OMV. Crucial future growth catalyst. The primary strategic growth project in the energy segment is Neptune Deep in the Romanian Black Sea, a joint venture between OMV Petrom, operator, 50% stake, and Romgaz, 50% stake. The development, with investments up to €4 billion, began drilling its first gas production well in March 2025. First gas is estimated for 2027. The successful, timely delivery of this large-scale gas project is essential for bolstering OMV's regional market position and contributing to European energy security. B. Cash flow and liquidity management. Financial performance is underpinned by robust operational cash flow. Cash flow from operating activities, excluding net working capital (NWC) effects, amounted to €1.485 billion in Q3 2025. Total reported operating cash flow, however, was nearly €1.1 billion, a figure less than the strong prior year, primarily due to significant negative NWC effects. This disparity indicates that while underlying operations are generating substantial cash, timing differences or operational shifts related to NWC caused a near-term drag on reported cash flow. Organic free cash flow for the quarter totaled €163 million. To further strengthen the balance sheet and prepare for transition capex, OMV issued new perpetual subordinated hybrid notes totaling €750 million in June 2025. These instruments were classified as 100% equity under IFRS and received 50% equity credit from rating agencies Moody's and Fitch. This sophisticated financial measure proactively manages the leverage ratio, 16% in Q3 2025, by securing long-term capital while minimizing the perceived increase in debt by credit rating agencies. V. Risk management and geopolitical exposures. A. The Russian divestment, risk mitigation and final status. A major source of geopolitical exposure has been materially mitigated. In March 2022, OMV determined that Russia was no longer a core region, immediately ending negotiations regarding the Achimov Formation interest and initiating a strategic review of its 24.99% economic interest in the Yuzhno-Russkoye gas field. At the time, OMV anticipated total value adjustments of €1.5 billion to €1.8 billion related to Yuzhno-Russkoye and receivables from Nord Stream 2 AG. The formal exit was finalized through a Russian presidential decree on December 19, 2023. This decree mandated the unilateral and irreversible transfer of OMV's shareholdings to new Russian entities controlled by JSC Sogaz and Gazprom. Proceeds from the transfer are required to be paid into a Russian special account. This sequence of events means the financial loss related to the seizure of these Russian assets has been largely realized. But the company has secured definitive clarity, removing the operational and headline risk associated with ongoing exposure to Russia. B. Geopolitical sensitivity in European energy markets. Despite the Russian exit, OMV remains sensitive to geopolitical volatility, which necessitates a conservative full-year outlook. The global energy landscape faces growing energy security risks. The Neptune Deep project, set to deliver first gas in 2027, serves a critical dual purpose, providing substantial volume growth for OMV and enhancing energy independence for Europe. By positioning itself as a key supplier of non-Russian gas, OMV strengthens its political relevance within the EU, potentially insulating it from some future adverse regulatory or political actions. 6. Valuation and peer comparison. OMV's valuation metrics reflect a market that remains hesitant about the integration risk of Strategy 2030, presenting a potential entry point for long-term investors focused on structural change. A. Multiples analysis. The price-to-earnings (PE) ratio for OMV, standing at 13.57x TTM November 2025, is slightly higher than the peer average of 13.3x. However, this multiple is severely skewed when compared against OMV's 10-year mean historical PE ratio of 4.02x. This elevated ratio reflects highly depressed earnings in the 2023-2024 normalization period following the 2022 anomaly, rather than true overvaluation based on projected future earnings. The most compelling valuation signal lies in the enterprise value to EBITDA, EV/EBITDA multiple, which is a low 3.7x. This low multiple implies that the market is applying a significant discount to OMV's enterprise value relative to its robust, normalized operating cash flow, EBITDA. For an integrated energy major actively pursuing a large-scale, diversifying chemicals merger and capitalizing on major European gas projects, this multiple suggests material undervaluation, especially considering the BGI joint venture's guaranteed annual cash flow component. B. Dividend attractiveness and sustainability. OMV maintains a highly attractive shareholder return profile, offering a trailing dividend yield of 6.39%, with some projections placing the future yield as high as 9.8%. The dividend policy was recently upgraded to enhance resilience and free cash flow. The high trailing payout ratio of 97% would normally signal precarious dividend sustainability if earnings were purely dependent on volatile commodity cycles. However, the forthcoming $1 billion annual floor dividend stream from BGI, expected post-Q1 2026 closing, is designed specifically to provide the structural stability necessary to sustain this high payout. The dividend policy is strategically shifting from being reliant on cyclical E&P cash flow to being reinforced by stable, non-cyclical cash streams from the integrated chemicals segment. C. Analyst consensus. Based on projections from 15 analysts, OMV AG carries a consensus rating of buy, 7 buy, 6 hold, 2 sell. The average 12-month price target is €50.69, ranging from a low of €43 to a high of €62. This average implies a potential upside of plus 2.44% from the current market price. This moderate implied upside suggests that the consensus view already incorporates a significant portion of the expected value, but a relative valuation model suggests a deeper value, estimating OMV to be undervalued by 42% against a base case of €82.19. The divergence in targets underscores the difficulty in valuing a company undergoing such a profound strategic re-rating, requiring a long-term view that factors in the transition to stable, diversified earnings. V. Conclusion. OMV AG is undergoing a critical, high-conviction transformation aimed at achieving structural stability and sustainability. The company's integrated model demonstrated strong cash generation in Q3 2025, driven by surging refining margins and growth in the chemicals segment. The operational strength, evidenced by €1.485 billion in operating cash flow, excluding NWC effects, provides the financial foundation for this transition. The investment thesis is rooted in two key de-risking factors: the stabilization of future cash flows through the BGI floor dividend and the securing of European gas supply via the Neptune Deep project, which is on track for 2027. These factors fundamentally alter OMV's risk profile, moving it away from pure commodity volatility. The market currently prices OMV at a highly attractive 3.7x EV/EBITDA multiple, reflecting an unwarranted discount based on historical volatility and near-term transition execution risk. Given the guaranteed cash flow from BGI and the strategic benefits of reduced capital intensity outlined in the updated Strategy 2030, this discount is unwarranted for an asset with a stabilizing cash flow profile. Monitoring factors. Investors should closely monitor the following key indicators. BGI transaction closure. Confirmation of the Q1 2026 closing date for the Borouge Group International merger and the subsequent inclusion of the $1 billion annual floor dividend stream in forward guidance. Neptune Deep execution. Any delays or cost overruns associated with the €4 billion Neptune Deep project scheduled for first gas in 2027. Refining margin cyclicality. Given the reliance on strong refining margins, Q3 25 margin $11.5 per barrel, to generate immediate capital, any rapid contraction in this market segment could temporarily strain free cash flow needed for capex and dividends prior to BGI integration.